401ks are by far the most popular retirement plan used by most Americans. Compared to IRAs, individual retirement accounts, 401ks take up nearly double the market share, and this makes them the backbone of U.S. retirement savings. And while they play an important part in retirement, mistakes made within a 401k can have profound consequences. So make sure you avoid these 4 common yet often overlooked 401k mistakes. Mistake number 1 is not taking advantage of the company match. Now, a majority of 401k plans are now offering a company match, and that is where the employer is going to match your contributions up to a certain percentage. And not taking advantage of that is missing out on literal free money. And it's not just free money that year, it's also free money in all the years that they match, all the years of your employment. And not to mention all the gains and compounding that's going to come from years and years of having those matches. So if your company has a match, at a minimum, you should be contributing enough to get the full match. Because again, it's free money. Mistake number 2 is not vesting their employer match. Yes, the employer's match is free money. But here's the thing, it may not be available to you until you're considered vested. Vested means that you have a non-forfeitable right to that money. Most employers require a certain amount of years worked before their contributions become vested. Your own contributions are always 100% fully vested and will always belong to you. But the company match may take a few years before it fully belongs to you. And employers use this vesting as an incentive to keep employees from leaving. So if you leave a company before that vesting time period is satisfied, you may lose out on some or all of your company match. Again, vesting only has to do with the employer match. Your own contributions that you make through payroll deductions are always 100% vested and always 100% yours. Mistake number 3 that we see in 401ks is not making your contributions a habit. One of the biggest reasons why 401ks are the largest retirement asset of most Americans is that they've been making consistent contributions over a long period of time, years and even decades. Not making this a habit is going to cost you a lot over the long run. Compound interest is a fire that needs fuel so that it can burn as hot as possible. It needs regular contributions. And if you only stoke the fire every once in a while, it's not going to be effective. So make your contributions a habit. And lastly, mistake number 4 is not knowing the account type and not knowing your investments. A majority of 401k plans now offer a pre-tax and Roth option. Do you understand the difference between pre-tax and Roth? Do you understand which one is going to be more beneficial to you? Choosing between pre-tax versus Roth or some combination in between is tax planning. It's making sure you're being efficient and diverse with your tax liability over the long run. So make sure you understand which type of account you're investing in. And for the investments, remember, your 401k again is just the account. Pre-tax or Roth is just the tax treatment, but you still need to make a decision on the investments within the account. You'd be surprised at how many people don't know what they're actually invested in within their 401k. Are you allocated based on your time frame, based on the level of risk that you want to accept? Not understanding this and not optimizing your investments can have profound consequences for your retirement. It can end up costing you a lot of money over the long run. So make sure you know the type of account you're investing in, pre-tax or Roth, and what actual investments you're choosing. There's a reason why the 401k is the largest investment for retirees and the backbone of their retirement. If you have questions on your 401k and how you should be making it work for you, reach out to a trusted professional. What you do now, good or bad, right or wrong, is going to have a profound impact on your future.